Rajya Sabha passes the real estate bill, ushering in the first dedicated regulation for the housing sector. The bill aims to protect home buyers and make the business far more transparent. Shot in the arm for oil explorers like Reliance, ONGC and Cairn as the Cabinet clears the hydrocarbon exploration policy, giving them pricing freedom on gas from difficult fields. The Cabinet also clears amendments to the Mining Act that will help make mergers for miners far more easier. Tutors line up for Lafarge's cement plants in India. ET now learns a Brazilian cement major and an Irish company are in the race for assets that are estimated to be worth 9,000 crore rupees. Vijay Mallya's exit to Britain rocks the parliament in India. Congress Vice President Rahul Gandhi hits out at the government for letting Mallya get away. The finance minister retorts, says the Congress-led government couldn't stop Lalit Modi either in a similar case. The Enforcement Directorate summons Kingfisher CFO A. Raghunath, former IDBI Bank Chairman and Managing Director Yogesh Agarwal and two other IDBI officials for questioning the loans approved to Mallya-owned Kingfisher. Hi there, good evening. You've joined us right here on Smart Markets. I'm Tanya Bharadwaj joining you from our Mumbai newsroom. Also on the show with me, Ajay Sharma for that market perspective. And as every evening, Krishna Kumar will join in with all the national developments. But first, we'll talk about what went down on trading floors here in India today. And it was a day of profit booking with both the Sensex and Nifty actually losing over 0.5% at the end of the session. So while you have the Sensex taking a 170-odd point haircut, it was the Nifty that's actually given up 45 points, but more importantly, even ending below that crucial 7,500 mark. Today, banks, FMCG, technology, as well as infrastructure companies seem to have caved into pressure. Not just that, you also had large caps that actually saw a fair amount of selling pressure as well. Infosys, for one, sliding the most in about 2 weeks after two of its founders have actually sold their shares in the company. You had BHEL that again fell to a 1 week low. Reliance Industries also taking a tumble, actually the most that it has in a month. So clearly it was a fresh bout of profit booking. And remember, this is probably a first that we've seen after that stunning post-budget rally that we've seen our markets log into over the last couple of weeks or so. But before we talk about our own markets, remember the big global cue that just about everybody had their eyes and ears peeled for was the ECB, and the European Central Bank today has actually packed in a punch. It's cut its key lending rate to zero, pushed its deposit rate further into negative territory, and also significantly expanded the size and scope of its asset buying program. ECB policymakers have basically cut the bank's key lending rate to zero from 0.05. They've pushed the rate on its deposit facility to minus 0.4 from the minus 0.3. The central bank has also announced that it will expand the size of its monthly bond purchases now to 80 billion euros from its current level of 60 billion euros. This begins in April and will also include purchases of investment-grade, euro-denominated, non-bank corporate bonds. The ECB has also said that it will launch a new series of long-term refinancing operations with maturities of about 4 years. First, let's listen in to President Mario Draghi.
This comprehensive package will exploit the synergies between the different instruments and has been calibrated to further ease financing conditions, stimulate new credit provision, and thereby reinforce the momentum of the euro area's economic recovery and accelerate the return of inflation to levels below but close to 2%. We are providing substantial monetary stimulus to counteract heightened risks to the ECB's price stability objective. While very low or even negative inflation rates are unavoidable over the next few months as a result of movements in oil prices, it is crucial to avoid second-round effects by securing the return of inflation to levels below but close to 2% without undue delay.
Okay, let's quickly take a look at what's happening then as far as global equity markets are concerned. And there you go, the CAC up about 1%. Same story for the DAC. But do keep in mind that you've actually seen some of those gains peter off a little bit. Look at the FTSE. It's actually now down in the red. Marginally so, but worth noting that you've actually seen almost all markets give up those handsome gains that they were sort of notching up when you first heard what the ECB really had in mind. Not just that, even oil prices have actually come off a little bit, and that's because now there's news that seems to have hit the market that supposed meeting in Moscow that was to take place later this month might not actually happen. And that's why you're seeing US crude as well as Brent crude also down, US down about 1%, Brent crude taking a sharper knock, something like 2%. But let's keep the focus on the big, global cue, and that's of course been the bazooka, so to speak, from the ECB. And for that, we've got a guest who's joining in, Sharmila Whelan. She's a Deputy Chief Economist at Asianomics Group. She's joining in on the phone line. Sharmila, good evening. Thanks so much for taking time out for us. Mario Draghi seems to have exceeded market expectations, but looks like, the markets have sort of already digested it and moved on, because you're seeing, most indices sort of pairing their gains.
Hi, Tanya. Well, to be honest, I have to say I'm not surprised. Draghi has certainly, as you mentioned, said yourself, delivered a big bazooka, and that's simply because he couldn't afford to disappoint markets after just delivering a 10 basis point cut in the deposit rate, facility rate in December. But the reality is that, these QE policies, these expanded monetary policy measures are going to have little or no impact on economic activity. I would argue that it's going to be hugely detrimental. The problem in Europe is not the lack of liquidity. If you look at the ECB's own monetary base, that's growing by about 41% year on year. This is compared to growth of 2.9% year on year in January last year. But the credit multiplier is not working. Credit peaked in November. Now it's growing by about 0.4% year on year. Companies are beginning to pay back debt because they're not convinced that this is going to work, and they're right in their expectations there that this is not going to help real economic activity.
Right. Sharmila, we spoke about the equity market reaction of these developments and commentary, but how did you gauge the currency's reaction? The euro, in fact, took a big tumble and then recovered all the losses almost in the green, which is not good for companies based out of Europe. Similarly, credit default swaps also eased out and then they recovered. In fact, a lot of people are reading the commentary coming out of Mario Draghi in the second half of the entire commentary was pretty bearish about the region. How do you analyze the prospects going forward?
I mean, we are very bearish about the outlook for the European economy. We're very bearish about the outlook for the global economy. The reason why our own view is that the global economy is headed for recession, and we've seen macroeconomic data fairly weak across the board, and that's mostly down to the QE policies out of the ECB and for that matter the BOJ, which is destroying US dollar global trade, and Asia seeing that firsthand, and now we're seeing, it's feeding back. The reverse loop is feeding back into Europe in terms of reduced demand there as well. So pumping more euros into the system that leads to a further weakening of the euro and a further contraction in European GDP in dollar terms is negative. And I think the market is realizing that.
Sharmila, of course, the action now shifts to what we hear Ms. Yellen say next week. And what's the expectation there? Because I don't think anybody expects her to move on rates, given the situation that we are in. And you yourself are sort of, making a case of how it's going to be bearish times ahead.
I mean, I think, as you rightly point out, that nobody's expecting Yellen to move next week. We would go one step further than that and say that our baseline view is that there's not going to be any further interest rate hike out of the U.S. In fact, we're looking for the U.S. interest 25 basis point hike that we've seen so far to be reversed. And we expect the U.S. economy to be in recession by the middle of the year, and our baseline forecast is for QE4 at the second half of the year.
All right, Sharmila, nice chatting with you. Thanks so much for taking time out for us. Let's bring the focus back and quickly talk about, what went down for us as well. And Ajay, as we were talking about how this is perhaps, the biggest bout of profit booking that we've seen ever since we've logged into that pretty decent rally post the budget. What were the internals looking like? 7,500, of course, on the Nifty lost. And would you say that seems to be now like a resistance level of sorts?
Looks like, Tanya, clearly, and for any Indian trader who's sitting on good amount of profits, going into this big event where, of course, it was expected that the stimulus would be expanded, the European markets were not really showing, or European market futures were not really giving any indication of that sort. In fact, around 3 o'clock, even the Dow futures gave up all the gains. There is where the temptation to take profits or even going into the market short actually came in, and that's why we gave up almost 200 points on the Sensex. Otherwise, too, day before yesterday, similar pattern played out. So there's temptation to take profits. But today, we also seen FIs not only sell, but also sell in index futures. So that is, something to take account of. They've been consistently adding positions in index futures. Not only that, banks and metals, clearly banks, of course, after the budget, it was only the prospects of a rate cut from the RBI, which was, aiding the rally there. But now increasingly there's a, point setting in that there's no intra-policy rate cut. So there was an empty number of reasons to take profits, and that played out. Whether tomorrow it's a big gap up or we sell out after a big gap up opening is, something to watch out for.
In fact, let's talk about that with our guests who are joining in then. We've got Nuresh Mirani, who's the head of technical research at Asian Market Securities, and Craig Earlham, who's a senior market analyst at Oanda. Gentlemen, both of you, thanks so much for taking time out for us. Nuresh, let me begin by asking you, let's first talk about, what the charts are telling you about the market today. 7,500, as, Ajay was saying, seems to be a sort of resistance level of sorts. Is that your own understanding as well?
So if we look at Nifty, we've seen a decent bounce from 6,800 to 6,850 levels all the way up till 7,500. The last top in the last couple of months was around 7,550, 7,570. Once that is taken off, we see a major trend change, also a follow-up momentum. And overall, we've bounced back in a matter of 10 to 12 sessions. So we have enough time to take out this resistance also in the future. So overall, till the time we hold 7,400, the trend remains positive for the short term.
Nuresh, in fact, let's take that point ahead, because you are also comparing the index movement, the Nifty movement with the Dow or even other global indices. Let's compare it with the Dow. You are making a point that this massive 10% kind of rebound for Indian markets and almost 10-11% rebound for global equities marks a change, or is a very strong indication that the bearish momentum is changing. Tell us about that particular hypothesis of yours.
So if we look at the current downtrend, it looks very similar to what happened in 2011, wherein Nifty fell around 30% over the next 1 year. Similarly, if you look at Dow Jones and Nifty today, what has happened is we made a bottom on Nifty around 6,850 levels around 12th February. At the same time, Dow Jones made a bottom at 15,500 odd roughly. But in the next move, we've seen a much lower low back to 6,825 on our markets on the back of budget. But at the same time, the global indices had already started moving up. So we are just playing a catch up. And the last time this has happened was similarly in 2011, wherein Dow Jones bottomed somewhere in September, October, as well as DAX and various global indices. And in the month of January 2012, we saw a move from 4,500 Nifty to 5,600 Nifty, backed by no major announcement. So we are getting into a similar zone wherein it is a sort of a hated rally wherein we've gone up by 10%, but we still don't believe this move.
Nuresh, hold that thought. In fact, Craig, I would like to understand from you, the latest jobs report may have bolstered the case for a rate hike. What's the kind of timetable you are working with, if you believe that still there are chances? Because increasingly the data points globally which they're emerging shows that perhaps the Fed may develop cold feet. What are your thoughts on that?
I do expect further rate hikes this year. I even since December, since we saw that first rate hike, even with the turmoil in January, I've always expected a couple of rate hikes this year. I think once the Fed began the path of tightening, I think it was important to continue, albeit at quite a slow pace, barring any form of crisis that was emerging. And I don't think a crisis is emerging, and I think what we saw at the start of the year is just is more stock market driven and less driven by really the economic fundamentals fundamentals. So I think it's good that I think it's important that the Fed persists with this tightening policy, and I think 2 rate hikes this year is very likely. I've not seen any really indication from the Fed that they're looking to stop the policy of tightening. We're seeing unemployment continue to fall. It's now below 5%. Wage growth, of course, is still lacking, but I think overall, if we look at the inflation numbers, which are picking up now, I think really everything does point to further tightening, and I think 2 rate hikes